Hello and welcome to the Monday Futures Market Outlook for August 23rd, 2010. This is Patrick Ceresna. Immunisource.com is proud to announce its release of its new trading room. 5-day complimentary memberships are available to try it out. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles that the market has gone through. We bullishly crossed above that line many months ago, and I'm begging the question as to whether or not we've started a new multi-year bull market, or whether or not this was just a false breakout that is going to return back under that 80-week moving average. We're at a very critical pullback at this moment. The two scenarios that we anticipate is, number one, we could find some good support off this level around the 1,000, maybe even as low as the 950 area on the S&P over the summer into the fall. Once we see some lows in there and some good supports holding, after good basing in there, the markets reverse and have a year-end rally. That's one scenario, but the reason that we maintain our bearish stance is that we certainly cannot at this moment rule out that this has been one big rising wedge to correct that bear market crash that we had in 2008. If this is nothing but a rising secondary corrective pattern, like a wedge, and that's reversing back down, that could signal that the market is going to resume into another full downtrend. The pivot which we're watching is going to be around the 1,000 level on the S&P, more or less. If the bulls can hold in and contain all selling over the next month or two around that 1,000 level, give or take 50 points, would go a long way to creating a bullish scenario. In the same regards, if we start seeing any accelerated selling below the 1,000 level, would start to make us consider that double dip scenario. Next year, I want to take a look at the S&P 500 on that daily charts. And when we look at it here, we were talking about that rising wedge going up into that 1120 area on the green focal point up above. We were looking for the summer highs to come in around that level, which we did, and we've now seen some selling coming in. At this juncture, we still believe that this market into the September-October cycle could go through a number of corrective patterns lower to come back and retest some of the key bottom zones. That 1040, 1050 focal point is critical, because if the selling is contained to that area on the downside, in fact, we can't rule out the possibility of another full swing higher. It would be a technical breakdown below that 1050 line with some accelerated selling that really opens the window for not only a move down to the 1,000 level, but potentially a corrective move that can go even as low as the 920 to 960 area on the downside. So watch that 1050 level very carefully today. Just to review our key points, our thesis since January 2008 continues to be that we're in a secular bear market, and we will not change that thesis until we see where the bottom comes in this current sell cycle. Again, that 1,000 level is going to play a very critical role over the next couple months. The highs of the summer rally are in, but again, we're approaching that critical 1050 pivot, which I think over the next week or two going into Labor Day will play a critical role in determining where the next leg of the move goes. In order for this market to get outright bearish, we need a breakdown below 1050. Even though we can have a short-term bias to 1050, it's not really bearish until we get under 1050. And under 1050, the window opens up for much deeper, stronger selling in that September cycle. However, if the bulls do hold that support this week and into next week, it could be a signal for a snapback rally to start off that level. So we'll consider that to be a critical pivot. We continue to be skeptical about the sustainability of any rally into the fall. We think the best case scenario is a year-end rally after we see some continued sluggishness over the next month or two. So it's very important to stay conservative in your investment portfolios. Next year, I want to take a look at the NASDAQ 100 futures contracts. Here we continue to see that same type of pattern with the little consolidation right around that 1780 to 1800 level, just right below. At this juncture, if we see any technical breakdown below 1800, it opens that window for a move that could go and retest not only that 1700 level on the downside, but could finish a move even as low as the 1550 to 1630 area on the downside, which is the measured move. At this stage, again, just like the S&P, the NASDAQ's going to have this pivot area around the 1780 to 1800 that's going to decide whether or not we see accelerated selling. Next here, I'm going to take a look at that U.S. dollar index futures contract. We continue to see some bullish breakouts here on the upside for a reversal back up. The retracement zone for the U.S. dollar index lies just right above this zone where we are, around this 83.50 as high as that 85.50 area on the upside. The one thing that will be critical here is if the dollar index fails to have any significant rally above the zone, that would indicate that there might be a retest of those lows that to put in. But in the same regards, if for whatever reason over the next week or two we see a very strong US dollar push all the way up to 85.50 to 86 and then subsequently can break above it, then we're in a full new move higher in the US dollar. So we're going to get some important information in the next point or two. Next here, I want to take a look at gold futures, and gold made a very nice push above the 1220 area on the upside. We were overdue for some sort of flag or wedge. A little pullback in gold here can even go as deep as the 1190 to 1210 area. But overall, even if we just see some very shallow selling here with no major technical damage done, we fully expect the gold to reverse back up and retest those previous highs, maybe even as high as 1260 on the upside. Next here, I want to take a look at the mini crude oil futures contract. More or less, the top of the crude came in right around that 80-82 zone that we were watching for. Really, at this juncture, we had that reversal back down and oil breaking down. We're going to be watching these previous lows around the 72 level on the downside. Down in that zone could be initial first-time support for a little bit of a flag backwards as we have some of the short sellers take some profits. But at this juncture, with this breakdown, at minimum, we're looking for a retest of the previous lows around that 68.70 over the next couple of weeks, if not a month or more. But if there's any real accelerated selling in the broader markets, oil can make it even as low as the 63 to 67 zone on the downside if there's a full move lower. Finally, I want to look at the 10-year Treasury notes, and we've finally seen that short-term high come in on the 10-year Treasury note around that 126 and a half zone on the upside. This is now a completed measured move on the upside. This is where we're going to see a little bit of profit taking. That does not mean it's going to be an end of the trend. We may see prolonged 1 week or 2 week consolidation work in here. Even pullbacks could theoretically go as deep as the 123 to 123 and a half, and then reverse bullishly back to the upside from there. So we're looking for a little bit of profit taking, maybe a little bit of short-term weakness here, but we are not calling a market top here. We just simply are looking for the Treasury notes to take a technical break. That was your Monday Futures Market Outlook. Thank you for joining me.